It's Brian Preston, the money guy.
Jay's question is up next. He says, I'm maxing out my 401k, IRA, and HSA, and also contribute to a taxable brokerage and a 529. So, should any excess funds go towards paying off my mortgage? It's a 2.25% interest rate. Or should he be investing more? And to give it some context, he's turning 46 this year.
Oh.
So fight. No, just kidding. But I know you're going to have some hot takes
Bo,
here.
give them the background, then I'll be the old man that gives the philosophical stuff, because I'm battling this personally now.
I was actually going to defer the kick into the second half, but okay, I'll take it now. I'll go ahead and receive. So here's the answer, Jay. I don't know your income. He didn't give us his income, did he?
No, he did not.
You're maxing out your 401k. That's $22,500. You're maxing out your IRA. That's $6,500. You're maxing out your HSA. I'm going to assume you're a family. Let's say $7,750. I'm going to guess that that's going to put you in the 25% savings rate. I don't know that for sure. You're also saving into a taxable account. You're also funding a 529. If you're following the financial order of operations, you want to hold it up for me real quick?
Oh yeah.
If you're following the financial order of operations, that suggests to me the fact that you're doing 529s now that you're in step 8, prepaid future expenses. Well, our general stance is once you've done all the things that you're supposed to be doing, the way that you're supposed to be doing, at this stage of the game, you get to do with your money what you choose to do with your money, meaning you don't have to think about optimization. At 46 years old, if you have a desire to begin paying down your debt so that you can be debt-free, that is an option. And remember, at the end of the day, money is nothing more than a tool that allows us to accomplish the goals that we want to accomplish. So if one of your goals is to be debt-free, then I think it's probably okay if you pay down the mortgage. However, if your goal is to optimize, I would sincerely and seriously ask you to consider the fact that you have a mortgage that's at 2.25%, which is super, super, super low. And save you retiring in the next 5, 7, 10 years, assuming you're going to continue to work until you're 55, 60, 65, you got a long-term time horizon. There's a really good chance that the dollars that you deploy out in the open market, especially considering that right now the market's down, it's not been a fantastic investing year, could likely grow at a rate greater than 2.25% over the interim term. So if you're thinking about optimization, there seems like there's a reasonable likelihood your dollars could do better out working for you in the market than they could satisfying your mortgage. When Brian and I have gone back and forth of this in the time, say your goal is to be debt-free by the time you're 55, I would argue that you might be better able to satisfy that goal by taking advantage of the low-interest mortgage, putting your money to work for the next couple of years, and then at age 55, having the opportunity and ability to just stroke a check and knock out the mortgage if you so chose.
So, Jay, I'm just going to give you the short answer and then give you the old man pontifications, because me and you are very similar in age and so forth, is that I think you can pay it off if you want. I mean, go ahead, let it rip, pay it off. You're over 45 years old. I think you've probably shown that you're doing definitely greater than 25%. So go ahead and do it. I'll share, and this pains me to share because it does fall into Bo's camp slightly. I'm not as heavy as he is on it. Because I just did my net worth statement stuff, and I had a goal that I wanted to be completely mortgage free by 50. I'm sitting on the horizon of that goal coming up in the not too distant future. But here's the problem I have. I have a 2.5% mortgage. I'm down to where I only owe $200,000 on the house. I have more than that in cash. But the problem is my cash is paying me. And now look, I know when you guys watch this a year from now, who knows where rates will be. But right now,
paying you significantly more than the mortgage rate.
I don't mind saying the number. I mean, hopefully people realize we're not always alive. I mean, but it's we are alive right now. But right now I'm getting paid a little over 4.3%. So you can see I have a dilemma. Mm-hmm. So here's what I've done. I've had to ask myself, what's the why? Bo and I, the pandemic created some weird opportunities. I'm always looking for, whenever there's uncertainty, I'm always looking around going, what should I learn? Especially after you have your financial foundation covered. You have your beyond step 8 of the financial order of operations. I think you can now start to taking more of a, what's next, or what's the why? What am I doing here? And Bo and I bought this building back in 2021.
Yep.
And it required, and it was because I was running fat on cash at that time. I still was saving and invest. We practice what we preach here. We eat our own cooking. We are not hypocrites in the fact that I am more than putting 25% to work of my gross income. But anything above and beyond that, I was planning on. That's why my mortgage is so low. Is that I just decided, I'll just let my cash fatten up. And see if another opportunity, because we're growing so well that I don't know if we need to buy land. I don't know if we need to be prepared for 5 years down the road that we need to do this. So I'm just trying to figure out the why, and that's what I would tell you, Jay, to figure out what your why is. Now, a lot of people, if you're not having to navigate a big, like we have a company now with getting close to 30 employees, I have to carry around the weight and the tail of that, so that we can cover payroll, so we can have the decisions for buildings and other capital needs in the future. A lot of people, it's just going to help you psychologically to be debt-free. Because the opportunity cost between paying off the mortgage versus what you can make in the cash, the spread probably might be small enough that you go, you know what, I'll just be happier. There's a lot of value. I've already checked the box that I'm doing 25%. It's just, what's the great situation versus is there a maximize even beyond the situation? And if there is, what's the why? And if you can't answer that, I at least can put some love on that, and the fact that I have this organization. I love people buying houses. I love them having babies. I love them seeing them have personal success. So I feel like I'm justified in having this growth plan. But for a lot of people, you ought to just say, hey, maybe this is where I'm taking more risk off of this, because I don't want to run the scoreboard up and be a jerk, when I kind of know what I like and what makes me happy, what makes me fulfilled. I've paid attention. Go watch our show on the 5 levels of wealth, and then ask yourself the why. And then, do the whole nerdy accounting thing that all CPAs do, is you got to do that T column where you have the pro column on the left and then the negative the cons on the right, and put the credits there. And then you figure out what's best for your household.